You have never missed a payment. Not a single one. You set up autopay years ago, and you check your accounts regularly. You pay your credit card bill the exact moment it shows up on your screen. You are doing everything right, by the book. Then you open your app one morning and see this. This line graph shows a solid, perfect credit history that suddenly drops vertically by 20 or 30 points out of nowhere. Staring at that gap feels unfair, especially when your payment record is flawless. The scoring system is actually looking at several other factors behind the scenes. Perfect payment habits alone will not protect your score. You are unknowingly playing a game governed by invisible rules. My name is Alex. A couple of years ago, I was on a streak of on-time payments for over 3 years. Then I watched my score fall by more than 20 points in a single month. I had no idea why. So I spent weeks digging into the mathematical formulas and reporting the mechanics that actually govern credit scores. Here is the truth I found. Paying your bills on time is essential, but it is only a baseline requirement. There are several other variables operating in the background. If a single one of them shifts, your score will drop, even while your payment history stays perfect. One very common hidden metric responsible for these sudden drops is called credit utilization. Credit utilization is simply the ratio of how much of your available credit is being used at the exact moment your card issuer reports your balance to the bureaus. This vertical bar chart represents a credit card with a total available limit of $10,000. If you have a reported balance of $3,000, the math dictates a utilization rate of 30%. The trap is in the timing. The system records and locks in that 30% usage penalty on a specific day, even if your physical balance drops back to zero because you paid it off in full a few days later. The credit bureau is grading a frozen snapshot of your debt rather than the responsible action of paying it off. That one detail catches a lot of people off guard. Here is what I want you to do right now, before this video is over. Log into your credit card app and look for a specific, often overlooked date. You are looking for your statement closing date. This timeline highlights your closing date, completely separate from the later payment due date. Carrying a high balance on the exact closing date triggers the snapshot, applying the utilization penalty. Paying to a zero balance the very next morning does nothing to reverse it. By simply knowing exactly when the closing date happens, you can proactively pay down your balance before that snapshot is ever taken. Identifying this timeline is your essential first move in taking back control of your score. But understanding this single date is just the beginning. I also want to show you how the wider foundation of credit scores is actually built. Because true financial control requires you to actively manage these hidden reporting dates, instead of just blindly paying your bills on time. Most of us grew up thinking of a credit score as a singular, imposing grade on our financial character, a permanent record from the banks. Every credit score is a predictable composite formula built from 5 distinct mathematical variables. This chart breaks down those 5 categories. The largest piece of the pie here represents your payment history. This is the foundation of the math, holding the most weight overall. Right behind it is your credit utilization. This tracks how much of your available credit limit you are actively using at any given time. Next, the algorithm factors in the age of your active accounts. The longer you keep a line of credit open and in good standing, the stronger the section gets. Finally, the remaining mathematical weight is split between 2 smaller elements: your mix of credit types, like having an installment loan alongside a credit card, and whether you have submitted recent applications for new credit. Recognizing these 5 separate buckets transforms the score into a transparent system of levers that you can actively manage. Of all those levers, credit utilization is the specific metric that consistently blindsides consumers who otherwise have excellent financial habits. Look at this fractional breakdown. Say you have a credit card with a maximum spending limit of $4,000 and your reported balance is $1,000. Divide that balance by your limit and you sit at a 25% utilization rate. Here is the operational trap. You might plan to pay that entire $1,000 off by Friday, but the scoring model only calculates based on the exact snapshot in time when the credit card company reported your balance to the bureaus. Watch the trend line added to the chart here. If that snapshot happens right when your balance is temporarily high, you will see a temporary downward trend in your overall score, regardless of your plans to pay it off. Utilization measures your exact debt capacity at a specific moment, not your long-term reliability. The exact day a balance is reported dictates your score just as much as actually paying the bill. The heavy hitters, like payment history and your utilization, are not the only variables pulling the strings. The three smaller scoring factors also trigger independent movements. For instance, actively applying for a new loan or credit card introduces what is called a hard inquiry. A hard inquiry is an official record that a lender has pulled your credit report to make a lending decision, and it applies a small, direct numerical penalty to your score. Then there's the risk of your lender deciding, on their own, to lower the credit limit on an account you already use. See how this plays out in our fractional breakdown. If the bank lowers your limit, the denominator physically shrinks. Even if you haven't spent a single new dollar, keeping the top number entirely unchanged, your utilization percentage automatically inflates. Similarly, closing an old, reliable credit card or opening a brand new one immediately alters the mathematical average age of your entire credit profile. The formula is highly sensitive to administration. A single operational shift from a bank triggers a mathematical cascade across multiple categories, penalizing a user who hasn't actively changed their spending at all. Adding to the confusion is the fact that there is no singular, universal credit score functioning behind the scenes. Equifax, Experian, TransUnion, and independent lenders all utilize slightly varied scoring models to weigh those 5 structural factors. Looking at these 3 parallel data streams, you can see how the exact same raw financial habits are processed to create 3 slightly varied numbers. If one banking app shows a 720 and another shows a 712, that is a mathematically normal outcome. Regardless of the specific model a lender uses, a sudden score drop is never a random system glitch. When the final number drops, we can trace that negative movement straight back up the line to a specific alteration inside one of those 5 core buckets. Treating your credit profile as a traceable diagnostic tool allows you to identify the exact data shift responsible for a change. Now we can look at the specific operational mistakes that trigger those shifts most often. You pay bills on time, avoid massive debt, and think you are doing everything right. But some common habits are secretly damaging your credit score. Being a responsible spender does not automatically translate to a high score. That 3-digit number is controlled by a strict set of mechanical rules, and those rules do not care about your good intentions. In fact, the scoring algorithm routinely interprets actions that seem financially prudent and organized as warning signs, penalizing you for keeping your accounts clean and tidy. If you want to protect your profile, you have to look under the hood and understand exactly how these hidden reporting mechanics actually work. The first major mistake happens when you try to organize your wallet. You have an old credit card sitting in a drawer. You never use it, so you call the bank and close the account. This chart shows your total available credit. When you close that old card, its specific credit limit is permanently wiped from your total available credit pool. Notice how the connected metric reacts. When your available credit shrinks, your credit utilization ratio spikes. Credit utilization is a metric that compares the amount of debt you currently have to your total available credit limits. So even if your spending habits stay exactly the same, you suddenly look like you are relying more heavily on debt. If the card has no annual fee, it can often make more sense to keep it open and use it once in a while for something small. The second mistake is putting your accounts on autopay and assuming your credit is perfectly handled. This timeline shows the monthly cycle of a credit card. The issue here is a mismatch between dates. Your statement closing date usually happens several days or even weeks before your actual due date. Your current balance is typically submitted to the credit bureaus on that earlier closing date. By the time your autopay finally triggers on the due date to wipe the slate clean, a high balance has already been recorded on your credit report. Autopay protects your payment history, but it does not automatically control your utilization. Those are 2 completely separate things. Relying strictly on automation will keep you safe from late fees, but if you ignore the reporting calendar, you surrender total control over the utilization metrics that heavily influence your score. The third mistake occurs when you apply for several new credit cards or loans in a short stretch of time. Every time you apply, the lender pulls your credit report, creating a hard inquiry. A hard inquiry is an official record of a lender checking your credit file to make a lending decision. A single inquiry will usually nudge your score down just a few points, but when you stack several inquiries together quickly, the algorithm reacts. This scale shows how multiple applications alter a lender's perception. Even if your finances are perfectly fine, seeking too much credit at once gets you flagged as a high-risk borrower. The fourth mistake comes from the false assumption that once you set an account up, your limits and details stay exactly the same unless you ask for a change. In reality, card issuers actively monitor their own risk, and they can unilaterally lower your credit limit with little to no notice. Let's look at a mathematical example. Imagine your limit dropped from $8,000 to $5,000 while you were carrying a steady reported balance of $2,000. Because that outer limit shrunk, your utilization just jumped from roughly 25% to roughly 40% overnight. You did nothing wrong, yet the math suddenly works against you. That is why a set-it-and-forget-it approach can backfire. When you leave your accounts on autopilot, you leave yourself vulnerable to unnotified background shifts that drag down your score before you even realize what happened. The final mistake is taking out a new loan or line of credit just to improve your overall credit mix. Credit mix is a minor scoring factor that looks at the variety of account types you have, like credit cards, mortgages, or auto loans. While having different types of accounts can matter a little in some scoring models, chasing a slight score bump is never worth taking on unneeded debt. If you did not need the debt before, a score trick is usually not a good reason to take it on now. None of these 5 pitfalls require a single missed payment. That is why so many responsible people get blindsided. Now that you know the silent traps, you can step off the autopilot. Here is the exact step-by-step plan for you to protect your credit profile and build it more intentionally. You already know how credit scores work. You know which habits to stop. But those defensive moves are only half the strategy. To really move the needle, you need to build an active system. Step 1 is building a simple credit calendar. For every card you own, track 2 specific dates: the payment due date and the statement closing date. Set a digital reminder for 3 days before that statement closes. When that reminder hits your phone, look at your current balance. This is your window to make an extra payment, lowering the amount right before the bank reports it. Step 2 requires managing large expenses on purpose. Whether it is a major car repair or a vacation, you have to think about the reporting date before the statement period ends. This chart shows how an early partial payment protects your profile. By paying down a portion of a big-ticket item before the closing date, the reported balance remains small enough to keep your score stable. You can also choose to spread a single large purchase across multiple cards. This distributes the debt and keeps the utilization percentage low on every individual account. Mapping these dates and timing your payments transforms the credit card into a precision cash flow tool under your direct control. For step 3, check your bank's app or call your issuer to see if a credit limit increase is available. Many companies offer these increases through a simple automated request, often without requiring a hard inquiry into your credit history. This chart demonstrates the mathematical advantage of a higher limit. As the total bar stretches upward, your actual spending, represented by the red block, occupies a much smaller percentage of the total available credit. Step 4 is establishing a digital perimeter. Set automated alerts for statement availability, high balances, and any large purchases. Automation is a start, but you also need a monthly manual review. Log in once a month to check your score and scan your account activity for anything unexpected. You are scanning for anomalies, an inquiry you never authorized, a limit change you didn't request, or an account you didn't open. Pairing expanded capacity with automated defense ensures you catch errors early, before they have time to compound and damage your rating. Step 5 moves to the home office. You can usually pull your full credit reports from the 3 major bureaus for free. Scrutinize these reports for inaccurate data. Look for unrecognized accounts, mismatched balances, or incorrect late payment marks. Correcting these requires filing a dispute with the bureau and lender. It takes weeks, but often provides an immediate lift to your score. Step 6 is about timing. Plan any new credit applications around your immediate, high-priority borrowing needs. Avoid stacking extra credit card applications if you are currently preparing for a major loan, like a mortgage or a vehicle purchase. This timeline shows the proper way to rate shop. When you are comparing specific loan offers, keep all of those applications within a short 2-week window to minimize the impact on your score. Controlling your report data and application timing prevents unnecessary algorithmic deductions during your most important life purchases. Finally, step 7. Set a new quarterly reminder to spend 15 minutes looking at your overall financial trajectory. This review is about the macro view. Track how your balances are trending across all cards and map out your borrowing needs for the next few months. Comparing your scores across different tracking platforms every 3 months is pure maintenance. It ensures your system is functioning exactly as intended. The bottom line is simple. A high credit score is the direct result of understanding the specific rules behind the number. Mastering all of these foundational pillars leads to total financial confidence and the permanent elimination of any future scoring surprises. If this system made credit scores feel more manageable, leave a like on the video. If you know someone who pays every bill on time and still sees their score drop, send this to them. Comment "score drop story" below and subscribe for new videos every Tuesday, Thursday, and Sunday. I'll see you in the next one.